Zero delivery. Shanghai officially prohibits public from taking physical silver January 2026. Shanghai issues a directive. The public can no longer withdraw physical silver, not delayed, not restricted, prohibited. Meanwhile, in Dubai, silver trades at $127 per ounce. In New York, COMEX shows 73, a $54 disconnect, the largest in modern history, 3 margin hikes in 14 days. Institutional buyers quietly moving tonnage out of registered vaults. But here's what they're not telling you. China controls 70% of the world's refined silver, and they just stopped exporting. This isn't a price move. This is a welcome to boring currency matters, where we don't insult your intelligence with hype, just the economic reality. They hope you'll ignore if you've built something in your life, a business, a career, real assets, then you understand why details matter. Hit that subscribe button because this channel treats you like the serious person you are. Not a gambler, not a speculator, a builder who needs to know what's actually happening. And before we continue, drop a comment below. Tell us where you're watching from, because this crisis is playing out differently, depending on which side of the world you're standing on. Now, let's break down what Shanghai just did and why it changes everything. On January 14th, 2026, a document appeared on the Shanghai Bullion Exchange website. Just 3 paragraphs, written in bureaucratic language, but what it said changed everything for anyone paying attention. The Shanghai Bullion Exchange announced that retail customers, everyday investors, business owners holding silver accounts could no longer withdraw physical silver from the vaults. Not delayed, not subject to additional paperwork, prohibited. The official term they used was temporary inventory management measures. But anyone who's watched commodity markets long enough knows what temporary means in government language. It means indefinite. It means they don't know when or if this reverses. Within hours, the phones started ringing. Traders in Hong Kong calling their contacts in Shanghai, investors in Singapore trying to understand what just happened. Business owners who held silver for industrial use suddenly locked out of their own metal. The confusion was immediate. Because the Shanghai Bullion Exchange isn't some small regional trading desk, it's Asia's primary precious metals hub. On an average day, before this announcement, the exchange handled approximately 180 tons of physical silver settlement. That's roughly $90 million worth of metal, moving through those vaults every single day. And now, how the doors were closed. But here's where it got interesting. The prohibition didn't apply to everyone. Institutional buyers, major banks, government-connected entities, they could still take delivery. The document specifically carved out exceptions for qualified institutional participants. So a retail investor who bought 100 ounces, locked out, but a major Chinese manufacturer who needed 10,000 ounces still had access. A small business owner building a precious metals position, prohibited. But state-owned enterprises, no problem. This wasn't about vault capacity, and this was about control, and the timing wasn't random. Just 3 weeks earlier. In late December 2025, the Chinese government had implemented a new export licensing system for refined silver. Suddenly, silver leaving China required government approval, additional permits, bureaucratic reviews, unexplained delays. The global supply chain, which had functioned smoothly for decades, started freezing. Refineries in Switzerland waiting for Chinese silver that never arrived, manufacturers in Germany scrambling for alternative sources, and now Shanghai shuts the door on physical withdrawals. 2 moves, 3 weeks apart, both targeting the same metal. Anyone watching knew. This was coordinated. So what does zero delivery actually mean? Operationally, it means you can still buy silver contracts on the exchange. You can trade them, sell them, watch the numbers change on your screen, but you cannot convert that paper contract into physical metal in your hand. You own it, in theory, but you can't touch it, can't move it, can't use it. It exists as a database entry, nothing more. For traders who were simply speculating on price, this didn't matter much. They were buying and selling positions anyway, never intending to take delivery. But for the business owners, the manufacturers, the investors who actually wanted the metal, this was a crisis. Because Shanghai wasn't just another exchange, it was the primary connection point between Asian physical markets and Western paper markets. Silver would flow from Chinese refineries through Shanghai, into Dubai, into Hong Kong, and eventually into Western vaults. That arbitrage network kept global prices aligned. When COMEX silver traded at one price and Dubai physical traded at another, arbitrage traders would exploit the difference, buy low in one market, sell high in another, pocket the spread, and in doing so, they kept prices from diverging too far. But now, one side of that equation just went dark. Shanghai, the largest physical silver hub in Asia, no longer delivering to regular customers. And when one major node in a global network suddenly restricts flow, the entire system starts to break down. Traders started asking the obvious question, if Shanghai won't deliver physical silver, how long before other exchanges face the same pressure? How long before temporary inventory management becomes the new normal? Because in commodity markets, there's a pattern. When exchanges start restricting physical delivery, it's never, ever, because they have too much inventory. It's because they have too little, and they're trying to hide that fact for as long as possible. But to understand why Shanghai made this move, you have to understand something most people don't know. China doesn't just participate in the silver market, they own it. In 2024, global refined silver production reached approximately 26,000 metric tons. Of that total, China controlled roughly 18,200 tons. That's 70%, not 70% of their own consumption. 70% of the entire world's refined silver supply. Let that sink in for a moment. 7 out of every 10 ounces of refined silver processed on this planet passes through Chinese facilities. This didn't happen by accident. For the past 15 years, while Western nations were focused on tech stocks and real estate, China was quietly building vertical integration in strategic commodities. They didn't just buy mines, they built the refineries, the fabrication plants, the entire supply chain, from raw ore coming out of the ground to 99.99% pure silver bars ready for industrial use, all happening inside Chinese borders, under Chinese control. A mining company in Peru might pull silver from the ground. But where does it go to get refined? China. A deposit in Australia might produce silver concentrate, but who processes it into usable metal? Chinese refineries? The geographic concentration is staggering. The majority of China's silver refining capacity sits in 3 provinces: Henan, Jiangxi, and Yunnan. Industrial zones where entire cities exist, just to process precious metals. Facilities running 24 hours a day, producing thousands of tons annually, and all of it, under the watchful eye of the Chinese government. But here's what makes this truly strategic. While China was building this refining dominance, they were also accumulating. Between 2015 and 2025, Chinese state entities and private buyers acquired massive physical silver positions, the exact numbers, unknown. Because China doesn't report their strategic reserves the way Western nations do. But analysts tracking import-export data noticed something strange. For years, China imported far more silver than they exported. The metal was flowing in, but not flowing out, disappearing into vaults, into reserves, into places the market couldn't see, building a strategic stockpile. And then, December 2025. The export licensing system, on paper, it looked like routine bureaucratic procedure, new forms, new permits, standard government oversight. But in practice, it was a chokehold. A Chinese refinery that used to ship 50 tons of silver to Europe each month now needed government approval for each shipment. Applications that used to take 2 days now took 2 weeks, then 3 weeks, then indefinitely under review. Quotas appeared, limiting how much each refinery could export monthly, and those quotas kept shrinking. Western buyers started to panic because their entire supply chain ran through China, an electronics manufacturer in Japan, waiting for silver shipments that never came, a solar panel producer in California, watching their inventory drain with no resupply, a medical device company in Germany, unable to source the silver they needed for antimicrobial coatings. All of them dependent on Chinese exports. All of them suddenly cut off. But the Shanghai Bullion Exchange wasn't just a trading platform in this equation. It was the enforcement mechanism. The exchange operates under direct oversight from the People's Bank of China. When the government wants to control commodity flow, the exchange becomes the tool, and they created a tier system. Tier 1, state-owned enterprises and government-approved institutions, full access. Tier 2, major Chinese manufacturers with strategic importance, limited access with permits. Tier 3, everyone else, good luck. Domestic prices inside China stayed relatively stable because the government could control internal allocation. But international prices, that's where things started breaking. Because when you cut off 70% of global refined supply from the export market, Scarcity becomes immediate, and price becomes irrelevant. It doesn't matter what COMEX says silver is worth. If you physically cannot get the metal, the paper price means nothing. This is economic warfare, not the kind with tariffs and trade negotiations. The kind where one nation controls a critical resource and turns off the tap. Silver isn't just a precious metal for investors. It's essential for modern technology. Every solar panel, every smartphone, every electric vehicle, every 5G network, all of them require silver, and the West just realized they don't control their own supply. China does, and China just decided who gets access and who doesn't. The Shanghai prohibition on public withdrawals, that was just the visible part, the part retail investors could see. But behind the scenes, something far larger was happening, a complete restructuring of how silver moves globally, and the business community was about to learn what it means when your supply chain runs through someone else's country. Now here's where the situation goes from concerning to alarming, because two different prices started appearing for the same metal, not a small difference. Not the typical $2 or $3 spread you see between markets, a chasm. On January 20th, 2026, a trader in New York looked at his COMEX screen, silver futures, $78.50 per ounce. That same day, a dealer in Dubai received a quote for physical silver bars, $127 per ounce. Same metal, same purity, same 1,000 ounce bars, but a 48 on 50 difference. In normal markets, this shouldn't exist, because when price gaps appear, arbitrage traders jump in immediately. They buy the cheap silver in New York, ship it to Dubai, sell it for the higher price, pocket the difference, and in doing so, they close the gap. Basic market mechanics. Except it wasn't happening. Because you can't arbitrage what you can't move. The traditional flow looked like this. A trader buys COMEX silver futures, takes delivery of physical bars from a COMEX-approved vault, ships those bars to Dubai or Shanghai, sells them at the Asian physical premium, easy profit, when the spread gets wide enough to cover shipping and insurance. Normally, that spread maxes out around $8 to $12 per ounce, enough to cover transport costs, insurance, vault fees, and still make a profit. But 48? That's not a spread. That's a broken market. So what happened? The metal stopped moving. COMEX vaults, which are supposed to hold silver available for delivery, started draining fast. In the derivatives market, there are two categories of vault inventory. Eligible inventory, which is silver stored in COMEX vaults but not available for immediate delivery. And registered inventory, which is silver specifically designated for contract settlement. The number that matters is registered, because that's the actual metal backing the paper contracts. In January 2025, 1 year before Shanghai's prohibition, COMEX registered silver inventory sat at approximately 285 million ounces. By December 2025, it had dropped to 198 million ounces. By mid-January 2026, after Shanghai's announcement, 142 million ounces, a 50% decline in 12 months, and the withdrawals were accelerating. But here's the really interesting part. The withdrawals weren't random retail investors taking 100-ounce positions. These were institutional-sized movements, 5,000 ounces, 10,000 ounces, 50,000 ounces at a time, banks, hedge funds, entities with vault capacity and logistics infrastructure. They were quietly, methodically, pulling physical silver out of the COMEX system and moving it where? Some to Switzerland, some to Singapore, some to private vaults in London, anywhere but COMEX. Because smart money recognized something. When Shanghai locks down physical delivery, when Chinese exports freeze, when Asian premiums hit $50 over paper prices, COMEX is next. It's just a matter of time. So the institutions started positioning, get the physical metal and before the window closes, and COMEX responded the only way exchanges can when they're losing inventory, margin requirements. On January 8th, COMEX raised initial margin requirements on silver futures by 12%. On January 15th, another 15% increase. On January 23rd, another 18% increase. 3 margin hikes in 15 days. For those unfamiliar with futures trading, here's what that means. Margin is the cash deposit required to hold a futures position. When exchanges raise margin requirements, they're making it more expensive to trade. More capital required to hold the same position. Why would they do this? The official explanation is always increased volatility to risk management, protecting market integrity. But traders know the real reason. Margin hikes are a control mechanism. When too many people are trying to take physical delivery, When the exchange doesn't have enough inventory to cover all the contracts, they raise margins to shake out the smaller players, force them to close positions. Instead of taking delivery, it's a way of saying, without actually saying, we don't have enough metal for everyone, so we're going to make sure only the big players can afford to stay in. And it was working. Smaller traders, individual investors, even some hedge funds, started closing their long positions, not because they wanted to, because they couldn't afford the margin calls. But the institutional players, they had the capital and they kept taking delivery. So the drain continued. COMEX, silver leaving, Asian physical premiums rising, Shanghai locked down, and the gap between paper and physical kept widening. By late January, some dealers in India were quoting $135 for physical bars. COMEX, still showing $73 to $85, a 50-plus disconnect. And financial analysts started asking the question nobody wanted to answer. If COMEX silver is really worth $78, why is physical metal trading at $127? And if physical metal is really worth $127, what are all these COMEX contracts actually worth? Because in a functioning market, paper and physical converge, they have to. But when they don't, when the gap becomes permanent, it means one of two things. Either the paper price is fake, or the physical price is fake. And in commodities, there's a rule. Physical is always real. Paper is whatever the exchange says it is. Until suddenly, it isn't. Part 4. The business strategic implications. So what does all of this mean for people running actual businesses? Not traders, not speculators, but manufacturers, business owners, decision makers responsible for supply chains and capital allocation? Because this isn't a theoretical problem anymore. This is operational reality. Let's start with the manufacturers. If your business uses silver in production, you have approximately 60 to 90 days before this crisis hits your operations directly, maybe less. A solar panel manufacturer in Arizona uses roughly 20 grams of silver per panel. Doesn't sound like much, but at scale, producing 50,000 panels monthly, that's 1,000 kilograms of silver every single month. Where does that silver come from? Historically, Chinese refineries, through established suppliers, predictable delivery schedules. Now, those suppliers are calling, saying deliveries are delayed indefinitely. So the manufacturer has 3 options. 1, find alternative sources, Peru, Mexico, Australia. But those refineries are already at capacity, serving their existing customers. And even if they can squeeze you in, expect 30% to 40% price premiums just to get in the queue. 2, reduce production, scale back panel output to match available silver supply, which means missing delivery commitments, losing contracts, watching competitors take market share. 3, pay whatever the physical market demands, 127, 135, whatever it takes, and absorb the cost increase, or pass it to customers and hope they don't walk away. None of these are good options. They're just degrees of bad, and this applies across industries. Electronics manufacturers, medical device companies, aerospace suppliers. Anyone who relies on silver in their production process, all facing the same calculus: how long can we operate with shrinking supply and exploding costs? Now let's talk about the financial side. If you hold silver as part of a business portfolio or personal wealth strategy, you need to understand something critical. Not all silver is equal anymore. Paper silver, ETFs, futures contracts, even some vault storage programs, they promise you silver. But do they actually have it? The term that matters now is allocated versus unallocated. Allocated storage means specific bars with serial numbers assigned to you, sitting in a vault you can verify. Unallocated means you own a claim on a pool of silver that may or may not actually exist in the amount claimed before this crisis. The difference didn't matter much. Now, it's everything. Because when supply tightens, when delivery fails, when exchanges restrict physical access, unallocated claims become hopes and prayers. Allocated metal becomes actual wealth. If you're holding silver through an ETF, do you know where the physical metal is? Do you know if you can convert your shares to bars? Do you know the redemption process and whether it's actually available to you or just to authorized participants? These aren't academic questions anymore. They're operational risk assessments. And beyond silver, there's a larger signal here. What Shanghai did to silver, they can do to other metals, rare earths, platinum, lithium, cobalt. China holds dominant positions across multiple critical materials. If they demonstrated willingness to weaponize silver supply, what stops them from doing the same with materials essential for batteries, semiconductors, defense systems? Western businesses spent 3 decades optimizing for cost efficiency, sourcing from the cheapest supplier, regardless of geographic concentration, just-in-time inventory, minimal stockpiles, maximum supply chain efficiency. That model assumed supply would always flow. That assumption just died. So what should serious business operators be doing right now? First, conduct a raw material dependency audit. Every critical input in your production process. Where does it come from? Who controls the supply? What's your backup plan? Not eventually. This month? Second, if you use silver or other Chinese-controlled materials, build inventory now, while you still can. Yes, it ties up capital. Yes, it goes against lean manufacturing principles. But having 6 months of inventory beats having 0 production capacity. Third, diversify sourcing geography. Even if it costs more, even if it's less efficient, supply security is now more valuable than cost savings. Fourth, for investment portfolios, understand the difference between price exposure and physical ownership. Paper contracts might show gains on a screen, but in a supply crisis, physical metal is what actually holds value. Fifth, watch the signals. When major institutions start moving metal out of exchanges, when governments restrict exports, when price disconnects exceed $50 per ounce, these aren't random events and they're warnings. And the business leaders who survive the next 24 months won't be the ones who dismiss these warnings as conspiracy theories or doom-mongering. They'll be the ones who quietly, methodically, and we prepared, the ones who built redundancy, secured supply, diversified risk, while everyone else was focused on quarterly earnings. Because here's the reality nobody wants to say out loud. Shanghai's silver prohibition isn't temporary. The Chinese export restrictions aren't getting reversed. The COMEX inventory drain isn't stopping. This is the new structure. And businesses operating on old assumptions are about to learn very expensive lessons. The question isn't whether this affects you. The question is how fast you recognize it does and what you do about it before everyone else figures it out.